Is Ford Motor Company a buy now? We're analyzing Ford Motor Company stock ticker F to see if it's on sale. We're using the Select 6 analysis to look at the most telling financial metrics. Then you'll want to stick around as we estimate a fair value and at the end give our rating. Along the way, there's going to be a key bonus metric that just might be the tipping point when analyzing Ford for your stock portfolio. This analysis will be intense but worth it. Before we get into these valuable metrics, how has Ford stock performed? Right now, Ford trades for $12.43 per share. Year to date, their stock price is up 7%. This is under the S&P 500, which is up 12.5%. In the last decade, Ford has trailed the market. Their stock price is down 29% overall, while the S&P 500 is up 160%. Going back before the global financial crisis, in the last 18 and a half years, Ford stock price is down 5.5% overall. Keep in mind these aren't their total returns to shareholders. Right now, Ford pays a big 4.92% dividend yield. Their average dividend yield over this time is added to the returns in their stock. Ford trades $3 below their 52-week high. They're up $1.50 from their 52-week low. There's some short interest with just under 4% of their shares sold short. Ford is a big, iconic American company. They have a $50 billion market cap. They use a lot of debt, so they have a $165 billion enterprise value. We'll touch on that more later in our analysis. But the burning question is, why should we be paying close attention to Ford? Ford Motor Company manufactures automobiles under its Ford and Lincoln brands. In March of 2022, the company announced that it will run its combustion engine business, Ford Blue, and its BEV business, Ford Model E, as separate businesses, but still all under Ford Motor. The company has about 13% market share in the United States, around 6.5% share in Europe, and just over 2% share in China, including unconsolidated affiliates. Its expected market share will increase as inventory improves coming out of the chip shortages. Sales in the United States made up around 67% of the company's revenue in 2022. Ford has around 173,000 employees, including 57,000 UAE employees, and it's based in Dearborn, Michigan. Now let's dive deep into their numbers. Metric number 1, we want their average return on capital in the last 5 years to be above 14%. The average business earns 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Automobile manufacturing is a tough industry. Because of this, historically they have low returns on capital. Ford is not an exception. Their returns were actually negative in 2020 amid chip shortages and lockdowns. In these other years, they've been lackluster as well, even though they have rebounded. In this time, Ford earns 2% returns on capital in a given year, coming in below an average business. Ford does use a lot of debt in their business, so they have better return on equity numbers, yet these are also going to vary year to year for the business. While their use of debt boosts their return on equity, Ford's return on capital is still below that. Ford has below average returns on capital. This is an X on metric number 1. Metric number 2, we're looking for growth across the business. We want revenue, net income, and free cash flow growth. These all need to be up. We'll also include Ford's numbers in their last 12 months, which aren't shown on this chart. In this time, Ford's grown their revenues by 6%. Their net incomes or their earnings have grown by 12%, even though they were negative in fiscal 2022. Unfortunately, Ford's free cash flows are down. They were negative in their most recent fiscal year. They're positive to date, but they're still down 25% from where they were at in 2018. Because of this is an X on metric number 2. Metric number 3, we want to see earnings per share growth. This looks at Ford from the view of an individual shareholder. Ford had negative earnings in their last fiscal year. However, they have positive earnings today that are actually up from where they were at in 2018. At the same time, Ford's issued a very small amount of new shares, just under 0.5%. Their growth in their earnings or their net incomes outpaces this shareholder dilution. It's our first check of the day on metric number 3. So far, Ford is 1 for 3. How will they perform in the second half of our analysis? 2, we're looking for free cash flow per share growth. Ford's free cash flows have fluctuated throughout this time. They were negative in their last fiscal year. While positive today, they're down from where they were at in 2018. When you add on their small shareholder dilution, Ford's free cash flows per share have shrank. They're down. This is an X on metric number 4. To recap, we have 1 check through our first 4 metrics so far. Before we look at Ford's debt and get to our valuations, it's time for our bonus. In our bonus, we want Ford's dividends to be supported by their free cash flows. Ford cut their dividend from 2019 until 2020. They further cut this from 2020 until 2021. Since then, they've actually been increasing their dividends. Ford's dividend payouts are where they were at in 2018. Right now, Ford pays a big 4.92% dividend yield, well above the dividend yield from an S&P 500 ETF. We want this to be supported by their free cash flows. That was the case in 4 of these last 5 fiscal years. Last year was an exception for the business, however. In their last 12 months, Ford has turned this around. Their free cash flows support their dividend payouts. Right now, they're paying out a 50% dividend payout ratio. This support is what we want to see. This is a check on our bonus. Now, does Ford look like it's in strong financial shape? In recessions, it's businesses with a lot of debt that can have the biggest losses or even go bankrupt. Metric number 5, we want Ford's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Ford has brought down their net debt over this time. They hit a peak in 2019 at $134 billion worth of debt. They ended last year with $108 billion in debt. Right now they have $115. So while this is down, it's not their lowest. In these fiscal years, their last year hit them the hardest. In these other 4 years, they produced $45.5 billion worth of free cash flow. They just produced $5.3 billion worth in their last 12 months. This is not enough to support their current net debt position. It's something you'd want to dig into the company's filings to understand in more depth. You want to see if this could cause issues for Ford or not. Understand how their debt is structured, when it matures, and what rates it's at. Their free cash flows don't support their net debt position. This is an X on metric number 5. Now, what's an estimate of a fair value for Ford? The big metric of them all, metric number 6, we want Ford's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we'll estimate a fair value for Ford. Right now, they have a $165 billion enterprise value. This accounts for both their net debt position and their market cap. It looks at Ford similar to it being a private business. In the last 5 years, we learned Ford produced $45.5 billion of free cash flow. This means they produced $9.1 billion in an average year. When that's divided by their $165 billion enterprise value, we get a 5.5% average free cash flow to enterprise value yield. That's above the yield from the 10-year treasury. On a current basis, Ford produced $5.3 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, we get a 3.2% current free cash flow to enterprise value yield. That's below the yield from the 10-year treasury. Both of these are split. We're looking at Ford on an average basis here, which was above the risk premium we wanted. This means on metric number 6, this is a check. We're not finished yet. Ford goes 2 for 6 on our analysis and they hit our bonus. Don't just run out and go buy the business. We still need to estimate their fair value per share and give our rating. Everything we've discussed so far is important, but there's still one vital piece missing that in my opinion is the main reason to analyze Ford. This brings us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with Ford's free cash flows and using historical assumptions to project these into the future. It's up to you to figure out if these will be accurate or not for Ford. They have a low business predictability, which makes this a rougher estimate than some other businesses. If we assume their free cash flows decline at 4% annually for the next 10 years, then in the following decade, if we assume these decline at 8% annually, we'll add in their tangible book value to give an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, if today's valuation multiples are the same 20 years into the future, an estimate of Ford's fair value is around $17 per share. That's more than $4.50 above their current stock price. Keep some key points in mind. Their business predictability makes this a rough estimate. It's still up to you to dig in and do more research. This discount rate is based on their free cash flows. It includes their average dividend yield and any potential gains in their stock. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk about our rating for Ford, but we need to address something first. We've covered the numbers, but Ford's qualitative factors may be even more important. Why don't we find out what these are? Ford also had significant developments with labor agreements, something GM and Stellantis still have not done with UAW. We have to start with the bad news first. Let's look at the factors supporting a short thesis. Number 1, the automotive industry is very cyclical, and until recently, Detroit automakers had been losing significant US market share to foreign automakers for years. Number 2, long-term profitability could be hindered by unions, which traditionally have wanted their share of the pie. The non-unionized import automakers in the US don't have this problem. Number 3, Ford stock can sell off heavily on macroeconomic fears, even if the company itself is doing well. Furthermore, it takes significant investment to fund growth in the auto industry, which limits potential margin expansion. Now let's look on the brighter side. Here are some factors supporting a long thesis. Number 1, Ford's turnaround will take a lot of time due to its many restructuring projects around the world, but so far the international business seems to be getting better. Number 2, Ford is focusing its investments where it gets the best return, which is why mostly exiting North American car segments and production in South America seems to be the profitable move. Number 3, Ford has tried to remove some administrative layers, and CEO Farley's aggressive moves into electric vehicles seem beneficial to the company's future, something Ford was slow to do in the past. Those are some of Ford's qualitative factors. Now it's time for our rating. We learned in analyzing Ford Motor Company, stock ticker F, they checked 2 of the 6 boxes on our Select 6 analysis, plus our bonus. Ford uses a lot of debt in their business, which led to some of these X's, especially as their free cash flows are down. They earn below average returns on capital, and it doesn't look like their free cash flows fully support their net debt position. That's something that could potentially cause headaches for the business. You'd want to dig into it. Ford has a large tangible book value, which we saw in our DCF. Their average free cash flow to enterprise value yield looks attractive compared to the 10-year treasury. Ford has some serious factors benefiting their future. Keep in mind this isn't financial advice. When we performed our DCF valuation, if Ford's valuation multiples are the same 20 years into the future, you believe those assumptions and you want a 15% rate of return, a rough estimate of their fair value is around $17 per share, up just under $5 from their current stock price. When we look at all the factors for Ford, Ford looks like an interesting candidate for more research. Learn more about the company. If you enjoyed learning about Ford, be sure to like the video and subscribe to the channel for more.